Many experts are keeping their fingers crossed whether China will once again save the globe from a global economic slowdown brought on by soaring inflation and the ongoing conflict in Ukraine. However, unlike 2008, when China's rapidly growing economy and a massive stimulus launched by the Beijing government assisted Western countries to emerge from the financial crisis more quickly, this time, China's economic difficulties are more widespread than ever before. The second largest economy is experiencing a turbulent economic time, characterized by repeated COVID government crackdown. The timing is unfortunate given that China is currently in the midst of preparations for the 20th National Congress of the Communist Party, which will take place in November and is anticipated to further strengthen President Xi Jinping's hold on power. Premier Li Keqiang issued a warning the previous month that there was little desire for more expansionary policy making at this time. The target for this year's GDP growth was set at 5.5%, but the government has almost completely given up on reaching that goal. However, the problems extend well beyond the pandemic and prominently include a bursting real estate bubble, an aging population, and the Taiwan crisis. Although China's economy is only around 3/4 the size of those of the United States or Europe, the country's property assets have expanded to be more than twice as large as those of the United States and more than 3 times as large as those of Europe. The result not only gives the impression that China is richer than it is, but also makes massively inefficient use of its resources. Recent research by Pettis found that during relatively prosperous times between 2013 and 2020, about 40% of the homes that developers pre-sold have not yet been built. In the past, property developers had historically relied on rising home prices and surging sales to justify excessive leverage and overbuilding, he said. Property developers had historically relied on rising home prices and surging sales. However, once the bubble started to deflate last year, these over-leveraged property developers ran into serious liquidity and credit constraints, which rendered it impossible for them to finish their construction projects. However, debt binges in the United States in the 1920s and Japan in the 1970s and 1980s came before calamities, Pettis noted that Beijing's control over banks and much of the rest of the economy signals a slowdown rather than a collapse in the Chinese economy. According to what he had to say, domestic financial conditions are such that it is still improbable that China will have a financial crisis or a major economic recession. In my perspective, the likelihood that the country will have a very extended period of poor growth, comparable to that of Japan, is substantially higher, he explained. He stated that reductions in interest rates, such as the one that took place on Monday, were not anticipated to stimulate significant additional borrowing, because consumers and businesses were deleveraging rather than taking on additional debt. Since 2020, Xi's crackdown on soaring property prices has resulted in the top 9 real estate tycoons losing a combined total of $79 billion. The decline in their wealth is symbolic of the catastrophe that has befallen China's real estate sector, an industry that accounts for around 70% of the household wealth in the country and contributes up to 30% to the country's GDP. The China Evergrande Group is the real estate company that has accumulated the largest debt globally. The Evergrande Group of China, which has become the world's most indebted property developer after amassing liabilities of $305 billion, was the company that suffered the greatest loss. And on top of that, Evergrande even defaulted in December last year. In the past 1.5 years, Chinese developers, including some of the most prominent ones, such as the Kesa Group, Shimao Group, and the Sanat Group, have defaulted on at least $18 billion worth of offshore dollar bonds and $2.5 billion worth of onshore debt. As a result of waning consumer confidence in the country's real estate market, both home prices and sales have been on a downward trend in China for a record 11 consecutive months. Given that pre-sales account for as much as 90% of all property transactions in China, this has made it more challenging for developers to pay for construction. The crisis has been worsened by the refusal of tens of thousands of homebuyers to pay mortgages on incomplete development projects. Only roughly 60% of the homes that were pre-sold by developers between the years 2013 and 2020, according to Nomura's estimates, will be delivered by those developers. It has been just 2 months, but the boycotts have already reached at least 320 projects in 99 cities, making it possibly the greatest protest against mortgages in China's history. There is an estimated $9 trillion worth of exposure that Chinese banks have to the country's real estate market, of which there is approximately $5.3 trillion worth of mortgage loans. The boycotts might affect as much as $291 billion worth of loans, according to estimates from industry analysts. Nevertheless, in contrast to the subprime mortgage crisis that occurred in the United States in 2007, when money was provided to high-risk borrowers who then defaulted on their payments, many people in China can pay, but choose not to. In order to coerce developers into reducing their levels of debt, China released guidelines in August 2020 that placed a cap on the amount of money that may be borrowed by developers. Some developers had their access to credit cut off as a result of the measures, which were referred to as 3 red lines, which set in motion a chain reaction of defaults. As a result of a real estate boom that has lasted for the past 20 years and has become fueled by the proceeds from pre-sold homes and debt, Chinese real estate has become the largest single asset class in the world, with a staggering value of more than $50 trillion. Similar to Japan, China will experience a slowdown as a result of real estate headwinds caused by the country's aging and shrinking population. If the Chinese population isn't currently declining, it could start to do so soon. According to Unravel, this would be the first economic downturn in the region since the 1950s famine. After 2021, the Shanghai Academy of Social Sciences projects an annual average fall of 1.1%, according to the paper in question. If that trend continues, China's population will fall from 1.4 billion to 587 million by the year 2100. Some have been predicting for years that China's debt bomb seems set to detonate, but there is a chance it could happen in the future, but not happening this year due to the COVID-0 policy. The research that was done on China's scrapped one-child policy suggested that a decrease in fertility was responsible for between 1/3 and 1/4 of China's per capita economic increase over the past few decades. It would be simple to represent the tensions caused by the visit of U.S. House Representative Speaker Nancy Pelosi to Taiwan as something that mainly involves the U.S. and China. However, China has responded to U.S. House Speaker Nancy Pelosi's contentious visit to Taiwan in early August with its largest ever military drills, effectively cutting off the island's access to maritime lanes and air traffic. The citizens of Taiwan are on edge as a result of live fire drills that are being conducted in the Taiwan Strait, which threaten to further destabilize the region. Despite this, the fact of the issue is that a significantly larger number of nations than previously believed have a stake in the future of Taiwan, and in the way that any potential scenario involving Taiwan plays out. Even though China's military superiority is hundreds of times greater than that of Taiwan, and even though the demonstration of China's military dominance is certain to add pressure, the island nation of Taiwan has been making preparations for any possible scenario, as it has been living in fear of an invasion by China for decades. But the timing of the fight makes matters worse because it comes at a time when Xi Jinping, China's most powerful leader since Chairman Mao, is eyeing an unprecedented third term in office. This makes the situation more complicated. According to Professor Pant, Beijing was testing the fortitude of the United States by threatening to escalate the situation over Ms. Pelosi's visit. But it recognized that its alternatives were limited, and so it was only doing this as a test. According to Professor Pant, China is also aware that a full-fledged war with Taiwan at this stage could be something that could be more catastrophic for China's interests. Despite the fire drills and the looming dread of greater hostilities, analysts have stated that trade is operating as usual. Despite this, Taiwan was initially forced to scramble for alternative routes for aviation and cargo, just as Ms. Pelosi was leaving office on August 3rd.